From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views. And today's discussion is part of our global series focused on Pillar 2 issues. This audience might be familiar with our series focused on these issues from a U.S. multinational perspective, but this series is focused more broadly. Today's topic is around the global accounting issues organizations are facing. And joining me today are Stephanie Hurst and Jay Morris. Stephanie is a partner in our UK tax practice and leads our UK global tax accounting team. And Jay is a senior partner in the US tax practice, and he's also the global tax accounting services leader for Deloitte. Really thrilled to have you both here with us today, as you are both leaders in Deloitte's global tax accounting group. And Jay, maybe before we get started, just tell us a little bit about what the global tax accounting group is.
Sure. Thanks, Carrie, for having us. So Deloitte's Global Tax Accounting Group, or the GTAC Group, it's comprised of tax professionals from around the globe, so jurisdictional members and Deloitte's affiliated firms, all with deep tax accounting skill sets, and they spend a significant amount of time on tax accounting. That can be everything from delivering global provision calculations for our non-audit clients to supporting the Deloitte audit business by auditing and testing the income tax accounts that are included in the financial statements of our audit clients.
Terrific. So let's get into the topic. So we know that accounting standards setters are providing guidance, lots of different guidance over the course of this year on how to account for Pillar 2. So Stephanie, maybe you can start us off with what does that mean for companies as they head towards year end for the first year where the rules are going to apply in many instances?
Yeah, thanks, Gary. It's been an interesting journey over the course of FY23 to see what the standard setters have done. But if I start with the International Accounting Standards Board, so the team that are responsible for IFRSs, everyone in the tax accounting world was incredibly grateful when the final amendments to IAS 12, the tax accounting standard, were issued in May 23. And that amendment was to provide updates in relation to Pillar 2 taxes. And the key thing was they provided a temporary exception for deferred tax that confirmed that we don't need to book or calculate deferred tax on Pillar 2 temporary differences. As most of us in the tax accounting community were pretty much scratching our heads on how we would even do that, it was a very welcome update and a very useful clarification. As a result, that means that Pillar 2 is a period cost. So you book the current tax impact of Pillar 2 in the period that it arises, and the ISB confirmed that it would be disclosed as a separate line item in the financial statements. They also looked at disclosures, because there's been quite a lot of thinking about that over the last couple of years as Pillar 2 has become increasingly sort of apparent that it was going ahead. And they looked at the concept where the rules have been substantively enacted, but not yet enforced. And so for many, this will be the sort of upcoming year or year end that's going to be the next one that they face, given that countries such as the UK and various members of the EU have issued or are issuing legislation this year. In this situation, companies must provide some disclosures to explain the known or reasonably estimatable information that users of the financial statements will need to understand the entity's exposure to Pillar 2 income taxes. So that means that they need to think about the qualitative and quantitative information that they can sort of draw together from their work to prepare for Pillar 2 and put some information into the financial statements as to what the impact will be in the future years. And therefore, it's important, I think, for companies to think about that as they head towards their upcoming year ends and talk to their auditors to decide what is the best thing that they need to put in. I would note that as with, because IFRS is a global framework, then many countries do have the concept of endorsement or adoption processes for IFRSs. And therefore ensuring that you understand the status of the amendments to IAS 12, has it been endorsed or has it not been endorsed, and what that means for any kind of periods coming up is important for both interims and year ends. As an example, we're recording this podcast today in August 23, and at the moment the EU is progressing well but hasn't yet endorsed it. So companies sort of within the EU framework for their accounting processes will need to think about that.
Well, yeah, that's just what I was going to ask Jay about. Like, I'm sure we have a number of U.S. folks listening to this. So maybe, Jay, you can comment on how it's different for you from U.S. GAAP.
I can. So similar outcome in terms of the concept of treating Pillar 2. What the FASB came out and said, it's going to be treated as an alternative minimum tax. So back in early February of 23, the FASB staff responded to a technical inquiry from several of the accounting firms asking whether an entity should record deferred taxes for the global anti-base erosion minimum tax by recognizing some of these globe-specific deferred taxes or basis differences, or even remeasuring some of the existing deferred taxes at the globe minimum tax rates. And what the FASB staff came back with was that they believe that the global minimum tax, as illustrated in the inquiry, is what's called an alternative minimum tax, and that's already covered in ASC 740. So what that means is, as an AMT, deferred tax assets and liabilities would not need to be recognized or even adjusted for the estimated future effects of the minimum tax. So therefore, multinational companies should continue to measure the total deferred tax assets and liabilities for the regular tax, okay, those regular tax temporary differences and carry forwards, and continue measuring them at the regular tax rate. And in addition, similar to what Steph said, the FASB noted that the recognition of that incremental Pillar 2 tax will be accrued in the year it relates to, so it would be a period cost. And then with regards to disclosure, the general disclosure requirements that already exist before Pillar 2 rules apply will continue to be the relevant ones. So no specific Pillar 2 disclosure requirements.
Thank you for that. So it's clear that for group financial statements that you're going to have to do disclosures and there's calculations. But what about standalone financial statements for single entities that might be prepared for local GAAP?
Yeah, I think this is a bit less clear, let's say. So definitely thinking is going into kind of what will influence what needs to be done in standalone accounts. And there are a number of factors which need to be considered by companies when they're thinking about this. And they include how the Pillar 2 taxes will be treated under the relevant local GAAP, so the local GAAP that applies to that set of standalone financial statements. And the sort of local accounting boards are catching up with the ISB and FASB in some instances, but everybody's going to need to monitor that to check where they are. We're going to have to see how Pillar 2 legislation is drafted and enacted as that will also affect kind of which countries need to think about the Pillar 2 taxes in what ways in their local financial statements. And then where the tax is actually paid, we've got a regime that has different elements. You've got the income inclusion rule, the under tax profit rule, and then you've got qualifying domestic minimum top-up tax rules. And the first two of those, the IIR and the UTPR, will both have tax being paid kind of sort of towards the top of a group in many ways, but kind of potentially not in the entity that the tax relates to. Whereas the QDMTT, the qualifying domestic minimum top-up tax, that will be linked directly to the entity it's related to. So understanding how companies are going to think about those different pieces, where the tax will arise, and will there be internal recharges in place, will drive kind of what happens in the financial statements. So as and when these elements sort of coalesce to be a lot clearer, then it should be possible for groups to design an accounting policy and approach for their single entity accounts. Fortunately, most countries have a longer deadline for these accounts compared to their group consolidated accounts. So it buys us a bit more time for that to become clearer and then for people to think it through.
Okay, that's helpful. I'm going to turn us now to talk about deferred taxes. So we understand that we don't have to calculate deferred taxes on basis differences for Pillar 2, but this whole concept of deferred taxes is a key component when we think about what covered taxes are. And this is definitely a new concept, right? We have deferred taxes driving cash tax in the form of Pillar 2 taxes. So are there some key emerging areas around deferred tax that companies want to consider now as they're thinking about how they implement these rules?
Yeah, absolutely, Carrie. Quite a few, in fact. So I think we're seeing that as companies are getting into more detail with, in particular, their modelling of the Pillar 2 outcomes, there are more and more instances where the tax accounting concepts are key, in particular deferred tax as well, to understand what's going on and what's driving the Pillar 2 cash tax outcomes. This is a very large topic, but I've tried to pick 3 examples to summarise that today. So the first one I thought about is the concept of deferred tax assets and the recognition criteria that needs to be applied. So the concept of valuation allowances when we think about US GAAP. And in the core Pillar 2 rules, the globe calculation rules, the impact of these adjustments are stripped out, which makes sense when you think about the fact that a deferred tax asset recognition adjustment will distort the ETR. The globe calculation rules are based on the concept of an ETR under the Pillar 2 rules. And therefore, the OECD said, well, that makes sense to make sure that we're not kind of creating an artificial distortion. It's helpful that they've done that. However, the impact of deferred tax recognition is very different when it comes to the safe harbour rules. So as a reminder on the safe harbours, these transitional rules were brought in by the OECD as a short-term measure to help companies where they've got operations in lower risk countries to minimise the compliance obligations when preparing full Pillar 2 calculations. So if you get into the safe harbour, it means no top-up tax would need to be accrued for that jurisdiction. So it really saves a lot of work and effort. But by definition, they've created it to be simple because to save the compliance effort, it needs to be a simple calculation. And that means that the rules do not exclude deferred tax asset recognition. So therefore, if you have a swing in your deferred tax asset recognition in a year, it's going to have an impact on the safe harbours. So if you get a DT recognition swing that is a credit, it will reduce your simplified covered taxes under the safe harbour and you might fall out. Of course, the flip side is that if you get a debit, then you would get a beneficial outcome on your ETR, might help you in the other direction. There are 2 other significant changes, I think, sort of within the Pillar 2 rules on deferred tax compared to the standard income tax accounting that are worth mentioning as well. The first one is the concept of rebasing your deferred tax position to 15% under the Pillar 2 rules. And so if your deferred tax items are at a rate higher than 15% in your income tax accounting calculations, then you need to redo that under Pillar 2 to bring it down to 15%. So that's kind of a key change that needs to be made when thinking about the Pillar 2 calculations. And then the second one is that not all deferred tax items are treated equally within the Pillar 2 rules. There's a general rule to recapture deferred tax movements that don't reverse within 5 years. So when you start to think about the complexity of tracking deferred tax items that go into your calculation over the next 5 years, and then what you have to do is recalculate that first year in year 6 if the item hasn't reversed, that's pretty challenging from a compliance perspective. And as a result of it being so challenging, the OECD did introduce a number of exceptions where this rule doesn't apply, for example, fixed assets. That's really helpful, but it doesn't mean that companies need to be clear on which of their deferreds fall into the recapture rule and which are kind of kept out of it through the exception. For those that are left in the rules, there's an election that allows you to exclude the deferred tax movements in year 1 rather than have to wait until year 6 to make the adjustment. I imagine this will be quite a popular election to reduce the complexity of the calculations.
So you can't rely on your current deferred tax analysis to support this, right? It's different items at different rates, tracked over different periods. That certainly sounds like a lot of work. Jay, maybe you can talk about what you're seeing companies do to get ready for the provision process.
And you're 100% right, Carrie. It is a lot of work. And so when we go out and we talk to our clients about what their readiness activities are, And by the way, that's right now. In 23 is when they're undertaking kind of a handful of different work streams. First up, I would say, would be scoping. What is the impact of Pillar 2 on their organizational structure when they consider both the operational and the jurisdictional tax profile of all their legal entities? Basically, which entities and jurisdictions will Pillar 2 likely apply to, and what are the quantitative impacts of that application? I'd say secondly is the data. As you've been hearing, Pillar 2 calculations, they ask new questions and they have different inputs than the regular jurisdictional tax calculation that companies are accustomed to preparing. So this means companies are reviewing the inputs into the calculations to identify what is that information that's needed, where is that information in their organization, and who's responsible for going to get that information. And they're also looking at technologies and tools to accumulate and curate that data quickly and accurately. I'd say another readiness activity that we've been having a fair amount of conversations on is what Steph mentioned before around the safe harbor. So the safe harbor is a more simplistic analysis when it's compared to the more detailed globe calculation that's required by Pillar 2. So to the extent that you can qualify for safe harbor, then companies not only wouldn't need to accrue Pillar 2 taxes for those qualifying jurisdictions, but also wouldn't need to perform that more detailed globe calculation. Now, currently, companies are evaluating the number of legal entities in their structure they can get to qualify for those safe harbor exceptions, so that they're left with just a reduced number of legal entities to analyze under the more detailed globe calculations. This can make their tax accrual process a lot more manageable. And this is part of a broader process point. I think companies are challenging themselves right now when they look at their provision process and how they can determine a good estimate for Pillar 2 taxes, given the already very short timeline that companies have for calculating their tax provisions at the quarters or at year end. Now, remember, this is an incremental calculation and accrual. So in addition to the regular tax amounts, the Pillar 2 tax needs to be determined. And companies are evaluating their current process and timelines, making changes or designing tax accounting approaches to efficiently estimate Pillar 2 taxes, considering things such as materiality and even forecasting. So they're looking at approaches such as maybe tiering entities in a risk-based tiering approach, whereby larger, more complicated legal entities and jurisdictions get a more robust estimation process and also more time devoted to them. And perhaps those entities in their structure that are immaterial or not that important or complicated, they may get a more limited and simplified accrual estimate and also less time to do it. So approaches focused on what's material and also just what's practical and what's achievable. Those are what companies are looking at. And as I mentioned before, clients are looking at their process to see where they can insert technology and tools to enhance the speed and accuracy. And I would note probably the most important thing, although not to downplay anything I just mentioned, would be that companies are definitely having conversations with all the constituents, okay? Setting expectations. So internally, what do their internal auditors want to see? What do their controllers want to see? What do their external auditors want to see in terms of documentation, controls, things like that? What is it supposed to look like, and what kind of support will need to be provided to the various constituents so that no one gets surprised when the calculations have to be undertaken?
I got it. And that's a great lead into my next question, right? Because you can't really talk about tax accounting without also talking about internal controls around tax accounting. So what are some of those considerations?
Yeah. So you're 100% right. All these changes and companies looking at their processes drift over and eventually start to consider internal control. So similar to how companies' current control environment provides comfort that the tax accounts determined and presented in the financial statements are accurate, Pillar 2 is requiring companies to refresh and in some cases establish new controls over their income tax accounts. So if you think about tracking and evaluating the significant amount of legislative activity that's coming out related to Pillar 2, as well as the new data, inputs, and calculations associated with the Pillar 2 calculations, things such as covered taxes and globe income, these amounts will need to be included in the control activities of the company. And some of those control activities will reside in the tax department, and many of these control activities will reside outside the tax department as well. And one area we continue to discuss with our clients relates to that safe harbor analysis that I mentioned, because a significant element of that safe harbor approach and those elections considers country by country reports. Those reports have historically been informational only, so it really didn't result in any financial statement implications. But now that the C-by-C reports will be relevant for tax accrual purposes because of Pillar 2, this means that the controls over those C-by-C reports should be sufficient, considering that relevance of the report to the financial statement accounts.
Got it. And maybe to wrap up, Stephanie, I'll go to you and talk a little bit about the provision team, obviously really impacted by the inclusion of Pillar 2. What would you say provision professionals should be focusing on?
At the moment, it's a question of a lot of planning. And I think all the things that Jay just talked about are really where the group tax teams and those responsible for tax provision in the headquarter country and company of a business are spending their time. And that's because sort of a lot of the focus of the work to date has been on the income inclusion rule, which is about focus on the tax that will be payable by the ultimate parent entity, so generally at the top of the group. And that makes a complete sense that they're spending a lot of time planning and thinking about that. I think as we move on to saying, well, what's it going to look like in real life, then we get into the element of what's happening in the headquarter country, what's happening in the local countries, how are the teams going to function across tax and finance at all those levels. And a few complexities can arise to make this quite challenging. So I think tax provision professionals need to be thinking about them sort of now and planning for them. The first one is timing. And as Jay mentioned, time is tight. Tax already comes at the end of the overall calculation for year end, and it gets squeezed up against external deadlines. So we're going to need to fit tax in to a timeline that may not be ready to fit a whole new calculation in. So communication and planning are going to be key between the group tax and group finance teams. Secondly, we have those QDMTTs to consider, which we talked about earlier. And these are the domestic rules that can apply in each country. And therefore, the local teams may well be thinking about how that works in their country, but the calculation structure may be very similar or indeed the same to the way that the income inclusion rule works. So who's going to take responsibility for that work? Where's it going to sit? Thinking about that is really important as well. And then finally, just picking like one more example, I think data collection. Most provision processes do not collect enough data to easily generate a sort of fully correct Pillar 2 calculation right now. So local and group tax provision team members are going to have to think about how they work together to update those processes, test them, perhaps part of a dry run or a modelling exercise, and then educate finance on all the new requirements. Some of it may be possible to automate, but I think in the early years, it's fair to say that there will be some significant manual effort, and that is going to take time in itself. So I keep using the same words, but fundamentally, communication, planning, timing, they're all going to be key. And I think working out how to do that efficiently and effectively will be what drives the success of tax provision team members over the next couple of years.
Well, thank you for that. Thank you, both of you, Stephanie and Jay. That is really useful information for organizations to be thinking about. As I mentioned at the beginning, this is part of a series that we're doing focused globally on Pillar 2 issues. We also have podcasts on compliance issues as well as the safe harbors. And you heard from Stephanie and Jay how important those two areas are. So hopefully our audience can listen in to those as well. If you'd like to connect with Jay or Stephanie directly, you can do so on LinkedIn. They'd be glad to connect with you. You can also get more information by going on Deloitte.com and searching Pillar 2. We have a lot of information out there. But again, thank you, Jay and Stephanie, for your time today. And thank you, audience, for listening in. I hope everyone continues to be well. Take care.